Hello, everyone, and thanks for joining us for Beyond Stocks, Diversifying with Alternative Investments. My name is Chelsea Seibel, and I will be moderating our discussion today. I'm going to start off with a few housekeeping items. If you have questions today, we encourage you to submit them during the discussion using the question box at the bottom of the screen. When we conclude today's prepared remarks, we will spend our remaining time answering questions that you have submitted. If we're unable to get to your question, we will personally follow up with you after the event. For your convenience, a recording of this event will be available on our website within the next several business days. Also, if you look at the bottom of your Zoom screen, you will see a tab called Resources. This will give you easy access to various links related to today's presentation. As I mentioned before, my name is Chelsea Seibel. I'm a financial consultant at Napier, and I primarily focus on the South Florida region. I serve as a quarterback to coordinate all aspects of wealth management for my clients, which include business owners, nonprofits, individuals, and families, to comprehensively meet their financial goals. I'm a certified financial planner practitioner and enjoy working with my clients to help them understand the ever-changing world of finance. I'm joined by my colleagues, Jeff Ingram and Nick Centennial. Jeff is the managing director of our portfolio strategies group. He works closely with our research team and is responsible for conveying the firm's view on the economy, capital markets, and portfolio management, as well as communicating the firm's investment processes and portfolio positioning across multiple sales channels. Jeff is also chairs the firm's product development and oversight committee. Nick is a senior investment consultant and endowment and foundation service lead. As a member of the firm's advisory services team, Nick works directly with clients on objective setting, cash flow analysis, and asset allocation. He's a frequent contributor to the firm's communication and thought leadership in the financial planning and nonprofit consulting space. So we thought we'd get started off with a poll to take the temperature of the audience and see where your knowledge base is on alternatives to help us tailor our presentation a little bit. Okay, and the question is, how much do you know about alternative investments? Are you allocating a portion of your portfolio in the asset class today? There are 4 options you can choose from, and I'll give you a second to respond. Okay, it looks like most of you have answered the question. So it looks like, based on the poll, most of you understand a little, but not invested yet. Some have a solid understanding, already invested. So we have a little of both, which is great. We'll have both high level and more detailed information to come. We are excited about this topic today because the alternative investment space is evolving and has especially done so in recent years. Most individual investors and smaller nonprofit organizations are used to the typical 60-40 portfolio allocation, meaning 60% stock, 40% bonds. However, we've been monitoring an emerging alternative investment trend, which is offering an additional layer of diversification to these same investors while also becoming more accessible. 2 years ago, we began an exciting new partnership with the Callodine Group, and they enabled us to go private again and expand our offering since they specialize in alternative investments. We're continuously collaborating to understand the potential and are working in parallel to bring new opportunities to our clients. As you'll hear today, alternative investments differ from traditional investments in several ways, including who can invest and the vehicles to do so. So you'll have to stay tuned for more news in 2025 next year, when you'll hear more on a multi-strategy vehicle with no restrictions on level of income or wealth. In the meantime, it's really important that we all have a clear understanding of the alternative investment space. The first step is educating ourselves on what alts are and how they can benefit portfolios. So the goal of the presentation today is to share an overview of alternative investments, highlight the benefits of investing in this asset class, and inform you on the different ways alternatives can be accessed. And then we'll wrap it up with question and answer. Let's dive in here. I have the privilege of working with clients on a daily basis and often hear reoccurring themes with what they are looking for. I'm sure many of you remember 2022, where we saw both fixed income and equities experience a major decline, which these asset classes have historically had this inverse relationship. I heard from many that they'd love an uncorrelated asset class. I hear from both my retirees trying to meet their retirement expenses and nonprofits trying to meet their spending rates and need for generating a consistent income stream. And I think this is true across the board, but all my clients would like to preserve their capital while still growing their portfolios at a healthy rate. What makes alternative investments so intriguing to us is they offer some kind of solution to all of these needs, therefore increasing the likelihood of financial success. But before I get ahead of myself, I think it would be prudent to take a step back, and I'll have Nick take the floor with talking about how you even start setting an objective for an investment.
Great. Yeah. Hi, everybody. Thanks, Chelsea. Yeah, it is a very common question that we get. I think the question is how do we build a portfolio with alternatives? How do we even determine if and when we should incorporate them? So this is certainly a great place to start. Up here on this slide, objective setting refers to establishing investment goals and allocation guidelines to meet those goals. Now, to do that, there's really two important things that you have to do. You have to know. You have to know yourself, and you have to know the markets. And specifically, you have to make assumptions about what different asset classes will do for your portfolio. So let's break it down a bit. You can frame your objectives in terms of three factors. Time horizon is how long you need your portfolio to last for. Spending needs are the magnitude, the stability, and the consistency of your expected withdrawals. And then risk tolerance is the level of volatility that you can withstand. Now, there can be other considerations too, things like liquidity, taxes, estate planning, and certain asset classes might become more or less suitable based on those. But I really think the core of developing your objectives really does lie in that time horizon, spending needs, and risk tolerance of what you want to accomplish. So consider this some sort of like know thyself, step one. Next, you have to allocate assets based on those goals. And to do that, you have to make assumptions, right, about how different asset classes will perform. We can think about this in terms of return, volatility, and correlation between assets. We call this market context. Now, over the short term, it's really hard to make good predictions, right, especially for an entire asset class. But over the long term, you can actually get pretty close. And one way to do that is to look at history as a guide. It's certainly not a guarantee, but past performance is helpful sort of as a baseline of what to expect for different assets. Another good way, current market conditions, that's another good guide. There is a relationship between starting valuations of an asset and its future return potential. So different assets can be more or less attractive based on whatever prevailing market conditions are today. So consider all this sort of a know thy markets step two. And then finally, the last step, you can combine all of this into a cash flow model, which is basically a way to forecast different outcomes within your financial plan. So take, for example, maybe I want my money to last until I'm 95. I want to spend $100,000 per year, and I don't think I can lose more than 20% in a single year. Or maybe, if you're an institution, we want to provide perpetual charitable support, and we want to keep pace with inflation. Our spending rule is 4% every year, and we don't want to fall in value by any more than 30%, just for instance. Now, a cash flow model will make a forecast using these sort of personalized constraints and the assumptions that you make about different asset classes. And then you can use that model to find the optimal asset mix that maximizes your chances of reaching your goals. And then stress testing is just sort of pushing the model to the limits. Maybe it's you want to test a scenario with higher withdrawals than you expect, or maybe just bad timing in terms of the market, things like that. So stress testing is important too. But the bottom line is a good financial advisor is going to be able to walk you through this whole process. But it does start with those three things. It's knowing yourself, knowing the markets, and then choosing a combination of assets to maximize your chances of success.
Thanks, Nick. This part is so important and why it's an area we really focus on in planning. It's pertinent to make sure we're matching the need with the appropriate investment and to understand those implications. So let's dive a little deeper into specifics. Jeff, would you mind giving us an overview of alternative investments?
Yeah, sure. Happy to do that. I guess I get the fun question of trying to define alternatives. I say that because I honestly think if you ask 10 people to sort of come up with a definition and come up with a list of alternatives, my guess would be each one of those lists and definitions might be different. And so I think in many ways, in sort of recognition of that, alternatives, as we'll use them and is commonly defined actually throughout the industry, is almost a definition by exclusion. It's what they're not. And so if you think about traditional asset classes being publicly traded stocks, publicly traded bonds, and cash-like instruments, I'm going to guess that every single person on this call has exposure in their investment portfolio to those traditional assets. Alternatives are everything else, everything that is not a traditionally traded stock or bond. So that's what we'll use as sort of the starting point for a definition. There are sort of dividing lines or dimensions at which you can make that distinction between traditional asset classes and alternative asset classes. We've listed 5 of them here. I'll go through each of them real quickly here. So public versus private is going to be a big one. That refers to both the underlying securities themselves. So on one hand, you might have publicly traded stock. On the other hand, you might have an ownership of a business. That doesn't trade, that's a private investment. So it could be the actual securities themselves, or it can be the vehicles in which you access underlying investment strategies. So a mutual fund that is registered versus a private fund. So public versus private is a big one. Liquidity is the other really big one. The traditional instruments I talked about before, stocks, bonds, cash, those are liquid within 1 or 2 days. So when you decide that you want to sell that publicly traded investment, you can turn it into cash almost guaranteed and almost immediately, right? Versus alternatives, a lot of times, because whether they're publicly, they're not publicly traded, so there's not available pricing, or just the structure of how you're accessing these investment strategies, you don't get that instant liquidity. And so that's probably one of the biggest ones when people go from traditional investments to alternative investments. The biggest leap often is that sort of liquidity jump that they end up taking. Now, what I'll say in some cases is liquidity, or that the relative lack of liquidity, can sort of be a feature rather than a bug of alternative investments. Because if you think about the next one here, volatility, when you can see the price of your portfolio or individual securities vary on a day-to-day basis, it can sort of induce almost bad behavior amongst investors. And there's been plenty of behavioral studies that have been done on this. And so alternative asset classes, oftentimes because they are not marked on a daily basis, will demonstrate lower volatility. Some of them actually do have truly lower volatility, but many of them give off what we'll call the appearance of lower volatility just because they're not trading on a daily basis. And again, that can be an advantage in some cases when you think about investor behavior. The fourth one here is complexity. And I think this one sort of speaks for itself. Publicly traded stocks and bonds are very easy to understand. There's a lot of information out there on them. And then the alternatives world can be relatively simple, but it can also have a lot of complexity. So there's a very wide spectrum there versus a sort of simpler spectrum of complexity when you talk about traditional stocks and bonds. And the last one is one I've sort of already mentioned already, is how do you actually access these investment strategies? So the fund structures that are available in the private or alternatives marketplace are quite different than what you see in the traditional asset marketplace. So with that as sort of a definition and the distinctions that you can often draw between traditional assets and alternatives, there are what we'll call sort of 5 main categories that alternative assets often fall under. You can see them listed here. So the first one, hedge funds. Hedge funds is actually almost more of a definition of a fund structure, because oftentimes what they do underneath or the investment strategies they follow, a lot of times hedge funds actually invest in traditional stocks and bonds, but the strategies they employ may use options, futures contracts, commodities, leverage, a lot of other tools to sort of enhance the risk return of a traditional asset portfolio. So that's kind of the hedge fund category. The next ones you see listed here oftentimes have sort of a public market equivalent as well. So you have private equity. I mentioned it before. It's private ownership of a business. You can have private credit, so extending loans on sort of bespoke private terms to businesses and other entities. You have real estate. You could be the owner of a building, or you could be a financer of a building. And then infrastructure is a little bit more of a catch-all category. So that would be things like pipelines and farmland and cell towers, things that sort of make up the infrastructure of our country and the world. So those are really the sort of 5 main categories under which alternatives are often sort of grouped or categorized. And so if you sort of combine those things together, we have many dimensions in which traditional assets and alternative assets can differ. And so if we were really going to try to plot this out, we would have this multi-dimensional chart. I haven't figured out how to make it yet. So what I've done here is I've taken, just for this purpose, 2 of the most important considerations. What kind of return am I going to get, and how long is my money locked up? So if you think of it along that spectrum, which we've done here, you would expect that if your money is going to be tied up for longer, you should expect something else in return. And oftentimes what you see in return for that relatively less liquidity is higher return potential. And so, starting on the left-hand side of the page, those traditional asset classes we talked about that are liquid within T+1 or T+2 day settlement. Then you get into the world of hedge funds where they are dealing with traditional asset classes. So maybe they can offer a little bit better liquidity terms. And then you get into the world of truly private securities, private assets. And, private equity, as we've listed here, perhaps offers the potential for the highest returns, but it also often offers the sort of least liquidity or the longest time period that your money needs to be locked up. So we're going to sort of revisit these trade-offs again, but this is maybe a good context and understanding sort of set the stage for the rest of our discussion.
Thanks, Jeff. Let's pause here for a moment for one more poll question, because everybody loves polls. There's 2 sections of this question. The top part is for those who are already investing in alternatives. And the second part, you'll have to scroll down a little bit, is if you're not investing yet. And I'll give you a second to respond here. But a couple more seconds here. A couple are dripping in.
I'll just sort of comment, Chelsea. I love what I'm seeing. I mean, the purpose of this webinar is really to sort of provide a lot of background and perspective on this. So I think we've got the right target audience here. It seems like a lot of folks here are coming here to learn about it. So it looks like we got the right makeup of the audience.
This is fantastic. All right, so we'll I'll go ahead. It looks like most have answered the question. So if you've already allocated to alternatives, it looks like at 69% of those that do, it's in real estate. The next one largest category is hedge funds. For those of you that are not allocating, it looks like your biggest hesitation would be lack of understanding, and then followed by limited liquidity. So That's great. This is great background for us to know. Okay, great. So we just went through the characteristics of alternatives. Now, Nick will touch on why someone would be interested in investing in alternatives.
Yeah, connecting back to the objective setting process, I talked about know thy markets, right? Here on this slide, we have the potential benefits of alternatives. Now, chances are, if you can improve on one or more of these factors in your portfolio, you can also improve the likelihood of success in your overall financial plan. So we have 4 things listed here. We have diversification. Alts can be correlated, can be less correlated with traditional assets, which is basically a fancy way of saying that their performance can act differently. Even if 2 assets offer about the same return potential, if they're uncorrelated, if they perform differently, they can smooth out a portfolio's overall volatility. If one performs poorly at times, the other one might be performing better at times, helping to offset the losses, for instance. So diversification is a big benefit. Current income is another one. Some alts give you higher income with similar or less levels of volatility than you can achieve in traditional assets. Private credit is a really great example here. Income is a benefit for investors who are using their portfolio to fund something, and this could be a retiree living off their assets, or it could be an endowment meeting its spending goal. So income is an important element of success for a lot of people. Capital preservation, Jeff mentioned previously, one important difference between private assets have versus public are that most aren't marked to market because they don't trade publicly. Now, the downside is you can't redeem your investments whenever you'd like, but the plus side is there's actually much less noise, and investors can be much more patient. This tends to preserve capital because you just don't see the day-to-day reactions in alternatives to every little bit of news like you do in the stock or bond markets. So the experience can be smoother for some types of alternatives. And then finally, enhanced returns. Many alternatives do offer better returns, either absolutely or per unit of risk. Think about it as more efficient returns, higher Sharpe ratio returns, things like that. For investors who target a certain return level, there, of course, are periods of time when, if you just look at traditional assets, that might not be enough. For example, stocks have been through periods as long as 10 years where returns have been negative. More recently, the 10-year bond is yielding at about 3.5%. Investors have to worry, whether that's simply going to be enough to meet, whether that's going to be enough return to meet their goals. So when the math of portfolio returns looks challenged for traditional investments, alternatives can be a really good way to make up the difference potentially. But of course, there's very few free lunches in investing. And for alternatives, there are definitely some unique risks that we should all remember. So first, there's transparency. And when it comes to holdings, disclosures, the frequency of valuation, many alts simply do not offer the same level of transparency as traditional investments. There's liquidity. And again, Jeff talked about liquidity concerns already for different alts. But just to highlight the point, you absolutely have to understand lockup requirements. You have to understand capital calls, and you have to build in these assumptions when you're making that cash flow model that we've mentioned already. We always recommend testing in your model, how resilient your overall portfolio is when it comes to liquidity. And simply put, higher liquidity needs, in other words, withdrawal needs for your portfolio, and or higher potential for volatility means that you have simply less flexibility to be illiquid. And so that's something that can be tested, can be stress tested to sort of evaluate within your plan. We've got fees on here. Alternatives are generally higher fees. These are complex, they're often actively managed, and it's not uncommon to see performance fees added to the total. So higher fees aren't really inherently a bad thing, but especially if you're receiving good value as an investor, but it's certainly a major point of evaluation you should know about. Leverage can amplify return and risk. So it means that you're basically borrowing money with the intention of earning a higher return than the cost of that money. Now, not all alts use leverage, and there are situations where it can be used conservatively, I think. But of course, there are also examples throughout history of too much leverage. And you certainly need to understand the risks here as an investor. And then finally, concentration. Again, it's not the case in every strategy, but sometimes particular funds can be very concentrated into just a handful of companies or industries. And that leaves them exposed to what we would call non-systematic risks, the risks that affect a specific industry or a specific company. These can be reduced through diversification, but again, sometimes that's inherently the part of the manager's strategies is not being diversified, being concentrated instead. So those are broadly the benefits and the risks. Jeff, I wanted to pass it on to you next. I know you have some specific data to demonstrate sort of the impacts of these different characteristics.
Yeah, so we're back on to me, and I guess for the next few slides, you're going to see my love of charts here, and who doesn't love a good XY scatter plot chart? I know I do. So I mentioned earlier that there are many dimensions, and Nick just went through some of them, right? The ways in which you have to weigh the risk and return or cost benefit trade-offs with alternatives. This is probably the most classical way of looking at an investment, though. What is the return I should expect historically from that investment, and what type of risk am I taking in terms of the volatility of that return over time? And so that's what we've plotted here. The portfolios you see along the sort of bottom half of the graph, those represent what we'll call your traditional investment portfolios with various mixes of stocks and bonds. And you can see it shown here. Now, ideal situation is to say, okay, well, I'm measuring my risk on the X or the horizontal axis here, and I'm measuring my expected return on the vertical or the Y axis. And so, of course, the ideal situation is I want to take the same amount of risk or get higher return, or maybe I get higher return and less risk, right? So you want to be moving kind of up and to the left. So what we've done here is we've just said, if you, instead of invested in traditional just stock and bond portfolios for the last roughly 20 years or so, last 2 decades, if you had allocated a portion of your portfolio, and in all these cases, allocating 30% to alternatives. And for those that maybe can't read the fine print, I'll just describe what we did here. We just took a sort of equal weighted approach of hedge funds, private credit, private equity, private real estate. So your portion of your portfolio allocated to alternatives, what you can see in every single case is that your return that you earned was higher and you took less risk, that volatility was lower. So clearly there has been a historical benefit to investing in alternative asset classes. Now, one other comment I'll make about, there's nothing magic about 30%. Right, a 30% allocation to alternatives is the right one, or the ideal one. I think we had a question pre-submitted about, sort of how much should I allocate to alternatives? I'm going to give the very unsatisfactory answer of it depends. I mean, it depends along all the dimensions that Nick talked about earlier. What's your time horizon? What's your tolerance for risk? What is your liquidity needs? And that applies to individuals and entities. But what I will say is that, if you're going to go through the exercise of adding alternatives or any asset class, really, you often would say, you know what, a minimum 5% allocation in a portfolio is really where it starts to matter. Anything less than that maybe doesn't matter very much. And I'd say, if you've gotten all the way up to 80%, you might have gone too far. It's time to turn around and come back a little bit. So again, there's no magic number to the 30, but what we're trying to do here is just demonstrate the power of diversifying a traditional portfolio with alternatives historically. Now, I think the other question is going to be, well, where did this higher return come from? Did it come from just one category of alternatives, and that's the one I should go after? And so what we've done here is we've laid out where we have a good public market versus alternative or private market comparison for equities, real estate, and fixed income. And we've looked at the returns over the last 3, 5, and 10 years. And so just starting on left-hand side of the page with equities, public equities have given very high returns for the last 3, 5, and 10 years. Private equity has done even better. right? And in this case, the difference is between 2 and 3 percentage points better over the varying time periods. A similar story with REITs. Maybe the return in REITs has not been as good as it has been in equities, but the return premium that you've gotten by being in private real estate has actually been a little bit greater, right? A 4 to 5% increase in the realized return over the last decade or so. But I think what might be surprising to a lot of folks is that the greatest sort of difference in return came in the fixed income markets. Now, I hate to have that sort of painful reminder that fixed income has been as challenging as it has been over the last 3 years, but you can see it here in the public markets. It's been very challenging in fixed income. But if you look at the sort of higher returns that were earned in terms of that difference, it's, 6 to 9 percentage points higher. So actually the largest delta in public versus private or traditional versus alternative returns actually came in the fixed income markets. And just to sort of hone in on that a little bit further, what we're going to show on the next slide here is just, the return that you should expect from a fixed income investment is often, well, what yield am I purchasing this security? So what we've laid out on the next chart here is just a variety of returns for different areas of the fixed income market. And so I think it's fair to say the return expectation for fixed income now is definitely higher than where it was when we were in the zero interest rate environment. So we've maybe crossed through that difficult transition period from a zero interest rate environment to where we are now. And so you can see that the returns in the treasury market are higher than what they were in years past. As you go into the investment grade and high yield bond market, you can see, well, I'm taking a little bit more risk, credit risk, duration risk, but I should expect a higher return. You see that on the yields there. Now, the closest kind of public market equivalent for private credit or alternative fixed income is often leveraged loans. That's the comparison that's often used. And yes, the highest yields are still available in the public market there. But again, look at the yield premium that is available in the private credit market. So for anyone that's really thinking about how can I generate more income, how can I diversify my portfolio? Again, whether you're an individual or an institution, private credit really offers sort of the most attractive, maybe risk return trade-offs that we've seen in the alternatives marketplace. And I think maybe, Chelsea, I'll just go back to you because I know that hopefully we've done a little bit of the sort of educational piece now. I think the other question mark for a lot of folks was kind of how do I invest it in and what are the liquidity requirements?
Mm-hmm. Yeah, exactly. So, we've gone through the pros and cons, but, we're going to pass it on to Nick to touch on who's actually using these alternatives and how are they accessing them.
We've got a good chart on the next slide here that really gives a good state of the world. It's based on data from today. So it's just sort of an update on the state of the world on who's using alternatives. And it shows the average allocation across different investor types. So on here, we've got the mass affluent, we've got high net worth, pensions, ultra high net worth, and endowments and foundations. And you can see that alts have traditionally been much more in the domain of large institutions and ultra high net worth. Now, one thing to note, especially on the endowment foundation side, this data is asset weighted. So very large endowments, think like multiple billions of dollars, they have a very much an outsized sway here. If you went and looked at smaller institutions, their average alts allocation would be much smaller also. So certainly one thing that stands out in light of this is the relationship between asset size and alts exposure. And from what we know about how the industry evolved, this does make sense, right? Access has been easier and fees generally lower if you have significant assets to place. Plus, to directly purchase most alts, regulators do require that you be an accredited investor, meaning there are certain income and asset thresholds to meet anyways. I suppose the one big trend that we wanted to communicate is that this is changing. There are more ways today for smaller investors to access alternatives. And in fact, this is where I pass it over to Jeff. I know, Jeff, you have a lot more info into particular fund structures that helps explain this access issue a lot more.
Yeah, exactly. I mean, so this is a busy and complicated slide, so just sort of allow me the grace and the time to go through it. So the question is, okay, we have all these various alternative strategies that I can select from, but how do I actually invest in them? And I talked about fund structure early on, and I would say that the greatest evolution that we've actually seen in our industry is not in the underlying alternatives themselves. It's how more and more investors can gain access to them. And so that's really what's depicted on this slide. So I'll just start on the left-hand side of the page. And so what you see here are what we'll call the traditional private fund structures. And they come in really, and we're going to sort of generalize a little bit, but two flavors. One is what I'll call the most traditional of private fund structures, which involves all of the capital being raised up front. You fill out the subscription docs to invest in that particular strategy, and the strategy has a very finite life. They're going to target returning your capital back to you in years, let's say 6, 7, and 8, or 7 through 10. And so these are private funds. They are not registered. They often have much longer lockup periods. There are oftentimes a lot of investor requirements or restrictions on who's allowed to invest in them. And for tax purposes, you're going to receive a K-1. The evergreen funds similarly are unregistered funds. They are the tax statement you're going to get is the same. It's a K-1. The only difference is really that they're open all the time, meaning you can put your money in, they will accept capital at any time, and there is no finite period for the return of capital. So basically, you can put money in, the subscription docs once, you can continue to contribute, but when you want your money back, you have to ask for it. They're not just going to dissolve the fund at a certain point in time. So it has the benefit of only having that sort of subscription frequency once, but for all other intents and purposes, it's very similar to your traditional closed-end fund. Now, I'm going to sort of leap over to all the way to the right-hand side of the page, and that's really how you can invest in traditional asset classes. Now, where I will draw a distinction here, and it's an important one to note, is that private funds do not have any regulatory requirements for the most part in what they are allowed to do and what they are allowed to invest in. So they can invest 100% of their portfolio in illiquid assets. As we noted earlier, a lot of alternative investments do not trade on a daily basis, so they don't offer that same level of liquidity. In contrast, open-end mutual funds, where there are no subscription documents, where there is a ticker that you can easily look up in Morningstar, where you can get information because it's registered, because this information is publicly available. They're easy to access. There's very minimum investor requirements. You can see the price on a daily basis. You can transact on a daily basis. You're going to get that nice 1099 instead of a K-1. What's the trade-off? There is a regulatory limit on how liquid that portfolio or illiquid that portfolio can be. And so there's a 15% limit to illiquid assets in a traditional open-end mutual fund. So I would say where the greatest evolution has taken place is you say, how can we marry these things? We want to be able to invest in alternative asset classes, but we want to make them more available to investors in a format or a vehicle that they're comfortable with, aware of, have used in the past. And this is where we get to the middle of the chart here, where we talked about where the greatest sort of evolution is taking place, and they're interval funds. And so interval funds are like any other mutual fund in that they are registered, right? So they're registered fund structures. They have tickers, right? So you're going to get your 5-symbol ticker, just like you do a regular mutual fund. You can put your money in at any time. Oftentimes there are limited to no investor restrictions, and there's no, massive form of subscription documents you have to fill out. So it really is like any other mutual fund, and you can transact, you can purchase them on a daily basis. Now, the name interval fund comes from the fact that when you want your money back, there's only an opportunity to redeem your shares at certain set intervals. Oftentimes it's quarterly. So there's really only 4 opportunities a year for you to ask for your money back. Now these, because they're, 40 Act registered, because of the way they have been structured, again, very similar to the traditional mutual funds, and you get a, 1099 tax statement. Now here, where the benefit comes in is that there is no limit on the amount of illiquidity or liquidity that an interval fund can offer. So these interval funds could be 50% invested in illiquid assets, 80% invested in illiquid assets, because they know that they have to offer redemptions, but only at certain intervals and in certain amounts. So it really is sort of taking the right-hand side of the page, right? The traditional mutual fund that everyone is familiar with the left-hand side of the page, which is how investors, institutional investors, have historically accessed alternative investment strategies, kind of combining them in the middle in this new interval fund structure.
Okay, I hope everyone's ready. We're going to do a quiz. No, I'm just kidding. I know this is a lot to take in, but as a reminder, we will have a replay of the presentation for those of you who are interested in hearing this information again. As a summary, it's a great time to be learning about alternatives because access has expanded and it's continuing to expand, making it a viable option for many investors. It can solve some common goals, including diversification of portfolio, providing a steady income stream, striving to preserve capital, in addition to providing enhanced returns. And just to be clear, this is not a case where you should sell everything to invest in alternatives. As part of a diversified portfolio, alternatives can improve your chances of success, but you should be selective and complementary towards your goal. It's also important to have a trusted advisor to guide you through this new territory. Alternatives are not all the same, as we heard Jeff just talk about. Okay. At this time, we're going to begin answering questions. Please continue submitting yours through the question and answer tab. So we already have some questions in here, so I guess we'll jump right into it. So the first question that I have here is, what is the best way to determine which alternative is best for your situation? So I think this is a good one for Nick to answer.
Yeah. So on this call, we have individuals and institutions. And so I think there's certainly a spectrum of different needs and characteristics that our audience is probably thinking about. But, I'm the man with a plan. I think it starts with a good financial plan first and foremost. I think a really good understanding of your objectives and constraints is called for. And again, a plan, what is and it isn't not. A plan isn't just broadly something like I need to grow or I need to preserve. I really think that's too general. I think a good plan should actually specify I need to grow X on average every year over the long term, or I need to preserve Y% of my value every year to meet my withdrawal needs. A good plan has specific targets like this. A good plan gives you a range of potential outcomes, not just a single prediction, but a forecast of the range of different possibilities, so you can account for the good as well as the bad. So I would have this plan in hand, and I would work with your advisor to just simply ask, where's the need or where's the shortfall in my existing portfolio, and is there an allocation out there that can plug that gap? I think that's really where the whole thing starts. But certainly working with a knowledgeable financial consultant, financial advisor is going to be a big help there.
Great, thanks, Nick. All right, the second question that came in, are alternatives suitable for a tax-deferred IRA? So I'll go ahead and take a stab at this one. So whenever we talk about suitability, it really comes down to each individual client situation. Alternatives are generally not available in employer plans, but a tax-deferred IRA can be a great account to hold alternatives. But again, it's really a case-by-case basis as to which account makes sense for your own situation. Okay, question 3. How do you measure or benchmark alternative investments? And this is a great one for Jeff.
Yeah, I mentioned it before. I think a lot of times there is often a public market equivalent. So oftentimes that's going to be a good benchmark. So private equity versus versus public equity, public index versus a private REIT investment, just as some examples. Some alternatives are sort of more difficult to benchmark in that way. So they're often thought of in either kind of absolute returns. Like I'm trying to generate more income from my portfolio. Having invested in this alternative, am I now generating more income in my portfolio, right? Or, I was traditionally in a 60-40 portfolio. Here's how a 60-40 portfolio of stocks and bonds would have returned. Now, how about my portfolio? Which allocated a little bit to alternatives. So maybe you're benchmarking the total portfolio rather than the specific alternative itself. And so I guess what I would, to summarize the answer, there are a lot of different ways to do it. It can be also very sort of situation by situation, case by case specific.
Okay, moving on to question 4. Are nonprofit organizations taking advantage of alternative investments, and how is this catching on or not in the nonprofit space? I know we touched on it a little bit in the presentation, but I'll go ahead and have Nick expand on that.
Yes, yeah. So nonprofits have historically been sort of at the forefront of the alternative space. In fact, there's what's called the endowment model, which was pioneered by Yale, in the 80s or 90s, and it's basically a model it strives for specifically for high alts exposure, really trying to take advantage of illiquidity and diversification across a lot of different types of alternatives. So yeah, nonprofits have played in this space for quite some time, but historically it's been the purview. It's only been large organizations really that have been able to do this, and those are the billion-dollar type endowments that we all know. And it's because the access just wasn't there for smaller portfolios. And even if it was, fees were very high or diversification was lacking, things like that. But we've mentioned how this is starting to change. There's a definite trend toward, I think, easier access. And I think I think this is a good thing, and it's definite. There's definitely a trend toward, therefore, smaller organizations taking a look at whether their portfolios can benefit as such. And I think many will find that it can. There's some distinction between different types of nonprofits. But I think of a core true endowment, having a very long-term time horizon, having very structured spending expectations. I think that's really well suited to handle illiquidity, because of all the different benefits that we discussed. Diversification, we talked about income and preservation and enhanced return. Each one can benefit most nonprofits if it's sort of think of itself as like a true donor endowment. So I think we'll continue to see alternatives catch on for smaller portfolios in the nonprofit space because of all this.
Yeah, it's exciting stuff. All right, moving to question number 5. Please offer your thoughts and advisement on tangible assets such as land, precious metals, real estate, as well as non-tangible assets like crypto. And I think this is right up Jeff's alley.
Yeah, sure. So, I'll reference back to what I started with in trying to define alternatives, because it ends up being defined by exclusion, right? It's everything that is not your traditional stocks and bonds and cash. So that it ends up including a lot of different things, right? And so we probably could have put a few more categories in there in addition to the 5 that we put out there. The 5 that we used, and again, that was hedge funds, private equity, private credit, real estate, and infrastructure. So I think in the case of land, and maybe some of these other alternatives, they go into a bit what I'll call the other category. So someone might as easily say, collectible items, right? Whether it be a signed baseball or a classic car or a painting or, a famous wine. Those could be alternative investments as defined by someone, and how they see it. So I think where you can start to say, okay, we grouped them in these 5, and now this other bucket. Oftentimes what you find with what I'll call the other bucket is that there's no underlying cash flows. And so that becomes a pretty important distinguish. feature where, you know, whether it's very unique items, like again, the collectibles that I mentioned, where there is no comparison for it, or in the case of cryptocurrency or precious metals, because there's no underlying cash flows, it's really harder to understand how you make the difference between investing and speculation. And I don't mean to say that it's doing that as speculation, but the only return that you can get from that is by someone else paying a higher price, because it itself doesn't give you a return. It doesn't throw off cash flows or income. So I think, yes, a lot of those things could be considered alternatives. They go into their sort of own unique bucket or other category for that reason of not often having underlying cash flows.
Great. Well, we want to be respectful of time here, so we're going to wrap up the questions, but if you didn't hear your question answered, we will be following up personally. If you have additional questions about anything we discussed today, please don't hesitate to contact us and we'll get back to you. We appreciate you all taking the time to be here with us today. If you can take a couple minutes to fill out the survey and give us feedback on any suggestions, it would be greatly appreciated. If you're interested in learning more about Manning Napier, please visit to schedule a call. We're happy to provide a free consultation where you can outline your personal financial situation, discuss goals, and we can actually prepare a financial plan that can summarize next steps for you and ensure you're staying on track. So on behalf of my colleagues, Jeff and Nick, and on behalf of Manning Napier, thanks for attending, and we hope you have a great day.
Thanks, everyone.